This is Oracle Corporation Key Fundamentals, a quick read on the company's financial health, straight from its SEC filings. Ticker ORCL, trading at $114.99, with a market cap of $331.17 billion. Start with one number, a 40.20% return on equity against just 6.53% return on assets. That gap is the headline of this whole briefing. It tells us Oracle's capital structure is doing real work, not just its operations. Every figure here traces back to SEC Edgar, so we're working from primary filings, not estimates. Here's the mental model we'll use. 4 layers. Filing, the raw SEC data. Scale, revenue, assets, cash. Efficiency, margins and returns. And valuation, what the market pays for that efficiency. Each layer explains the one before it, so we'll move through them in order. On efficiency, a 30.59% operating margin and 25.37% net margin, strong for any industry. But the number to watch is return on equity at 40.20% against return on assets of just 6.53%. That 6 times gap usually points to leverage or an unusually small equity base. Let's check that next. Total assets, $261.76 billion. Cash, $31.29 billion, both consistent with a company this size. But long-term debt and debt to equity are both reported at 0, which is hard to square with that earlier leverage signal. Oracle has historically carried significant long-term debt, so this is one figure worth re-verifying against the latest 10Q before citing it anywhere. On the income statement, $67.36 billion in annual revenue, converting to $17.09 billion in net income. That's the 25% net margin in dollar terms. Diluted EPS comes in at $5.83, implying roughly 2.9 billion diluted shares outstanding. Now, what the market is paying. Shares trade at $114.99 against a book value of just $14.76, about 7.8 times book, and the trailing PE is 19.72. Together, that reads as a premium for capital efficiency, not asset value, though it only really means something next to sector peers. Oracle is classified under SIC 7372, prepackaged software, placing it alongside enterprise software and cloud infrastructure peers. That classification lines up with everything we've seen: high margins, high returns on equity, and a business that scales without heavy new asset investment. 4 takeaways. 1. Efficiency, not just scale, is the story here. 2. Verify anomalies, like that 0 debt figure, against the primary filing before repeating them. 3. Valuation numbers like PE only mean something with peer context. And 4, an NA field isn't a dead end. It's usually just one filing away. All figures sourced from SEC Edgar, CIK 000-134-1439. For anyone going deeper, Oracle's latest 10K and 10Q, the most recent earnings call, and peer filings from Microsoft, SAP, and Salesforce. This is an educational briefing, not investment advice. Thanks for listening.